Two of the most common questions we're asked about buying an investment property are, how much is it going to cost me after tax per week, and how many years till it turns cash flow positive? Our negative gearing calculator is designed to tell you just that. When you use our negative gearing calculator, it's when you're looking around for an investment property and just unsure about whether one property is better than another or how much you can afford to do. And but you can do some great what-if analysis by changing the variables around. And so when you've found the property that you like, you can then go into more detail and do some more research as to what type of structure you need to put it in, whether it be a trust, individually, tenants in common. So let's work through how to use it. The first one we've got is your taxable income. So let's, for example, put in $100,000 there. The next one is we're going to put in some details about your property details. So we're going to put in the property price. Let's just say it's going to be $450,000, and then we're going to put in the loan value. Now we're assuming that you've got a 20% deposit, so let's put in $360,000. The interest rate, the current interest rate is about 7.15% on residential properties, on investment properties. So let's put in 7.15%. Now the capital appreciation per annum. This mainly affects how many years it's going to go into cash flow positive, but we're going to assume a fairly modest 4% per annum. The rental income per week, now you can get some advice from this from the agent, etc. But a simple rule is just drop 3 zeros off the purchase price. You can get a fairly good idea of what the rental income is going to be. That equals about a 5% gross rental return. The next one is number of weeks rented per year. Not every property is going to be rented for the entire year, so let's put in a conservative figure of say 50 weeks per year. The expenses, we've got strata levies, rates, water rates, repairs, leasing fees, and we're going to assume that's going to be say $5,000 a year. Now the other one is depreciation. You can actually claim depreciation for the capital on the cost of building the property, even if you didn't buy it yourself. So let's assume for the purpose of this $6,000 per annum. So let's hit calculate, and we see that the net after tax return cost per week to you is $51.66 to buy a property at $450,000, and it's going to take 7 years based on a 4% capital appreciation before it turns cash flow positive. We've got a loan. We've also put in there some important ratios, being the net rental return, which we've got at 3.89%, which is in the range of a rental property, and we'll LVR ratio of 80%. Some of the things that we can do with our negative gearing calculation, you can start to change these variables to see what it means. So you might change the interest rate to see what that effect's going to have. You might change the loan ratio or change the expenses per year, and you can just get a pretty good idea of how much it's going to cost you. Of course, if you need more advice, you can always call us at Dolman Bateman, and we're more than happy to help you out with advice into your investment property and what the appropriate structure is.